Section 5.3 is all about property taxes. So to calculate property taxes, you have two main factors that go into that calculation. The first factor is the assessed value of the home. Now, the assessed value of the home is not the same thing as the market value of the home. The market value of the home is the amount that the house you're living in right now could probably sell for. An assessed value of the home is going to be a lot less. Typically, the assessed value will be between 40 to 60% of the market value. The second factor that goes into property taxes is the tax rate that you're going to pay. And this is typically used from tax levies. And so voters in those areas will vote on different tax levies. And if those levies get passed, then people who live in that area are going to have to pay taxes on that. So tax levies are what are used to determine the tax rate. So we're going to look very specifically at Hamilton County, Ohio, and we're going to see how you would actually calculate out property taxes for a home that's inside Hamilton County. So the first thing to consider is that every 3 years the county will go around and they will determine the fair market value of the homes. Once they determine that fair market value, they're going to take that amount and multiply it by 35%. This is the assessed value that they use for property taxes. They'll take that assessed value and then they divide it by 1,000 and multiply that by the mill rate. Now, what is a mill rate? Well, the mill rate is a property tax rate calculation based on each $1,000 of assessed value. Once you've done that, you actually now have the basis for your annual property tax. There are adjustments, though, that get made to that basis. You need to add any special assessments that go against the property, and you need to subtract off any credits that are due to that property. Once you've done that, you now actually have the annual property tax amount that's due. But in Hamilton County, property taxes are paid twice a year, so you need to divide that number by 2. So let's look at what some of these tax levies are, what the special assessments might be, and what credits you can get. So in Hamilton County, Ohio, they have several tax levies going on right now, tax assessments. School district tax, this one's going to vary regularly depending on which school district you're in. That's why I say varies. The county general fund tax is 2.26 mills. That's an ongoing tax. It does not necessarily expire. The public library has a tax right now. It's 2 mills right now, but 1 mill will expire in 2023. So when you see something that says expires, that means that if the voters don't renew this tax levy, that it will go away. Typically, a lot of these tax levies actually get renewed. So even though it says expires, it may be renewed, and it would be for another 3, 5, 10 years. We've got on here family services, developmental disabilities. The Great Parks has one. All of these do expire in different years. Crime Information Center, that's just an ongoing tax. That is not determined by a tax levy at all. Children's Services gets taxes, and that is something that will expire. And then there's one for zoological parks, and that has some that will expire. All right. If we look at some of these special assessments and credits, special assessments are things that increase the amount of property tax that you have. So here I have, let's say that they make an update to the assessed value of your home because the market price is going to be changing regularly. So they're going to have a current value of your home that's going to be either increased or decreased. So if they increase the current value of your home, then it's going to be an increased special assessment that you're going to have to pay for. You could also have a delinquent assessment, which means that they did not actually assess the value of your home timely. And so within a certain period of time, they make an adjustment because they should have increased the current value or they should have decreased the current value. So if they increase it, then that's going to increase your taxes. If they decrease it, it would reduce your taxes. The last item under increases is delinquent taxes. And that means that let's say you didn't pay your taxes. Well, you have to pay back taxes, and then you'll also have fees associated with your bill because you did not pay your taxes on time. On the other side, though, for credits Credits will reduce your taxes. So the first thing is a reduction factor. If you live in Hamilton County, most people get a reduction factor on their taxes to help lower their taxes overall. If you are not a business, you get a credit for not being a business. If you live in your home and you're not renting it out to someone, you get the owner occupancy credit. People that are older, they get the homestead reduction credit. That way, if you're older and you're living on a fixed income, your taxes are reduced. And finally, you get a sales tax credit as well in Hamilton County because we pay sales taxes most likely if we're living here. We're probably buying a lot of things here and we're paying sales taxes. So we're going to view one practice problem to kind of go through some of these calculations associated with property. Okay, Matthew lives in a home with a market value of $150,000. The assessed value of his home is reduced to 35% for property tax purposes. He pays property taxes at a rate of 3.75%. Determine the following. So number one says, what is the assessed value of his home? So in order to determine the assessed value, I am going to take the market value of his home and I'm going to multiply that by this 35%. So over here, his market value is $150,000 times 0.35. And when I do that, that gives me $52,500. This is the assessed value of his home that we're going to use for calculating property taxes. Number two says, what is the tax rate per 100? So in order to determine the tax rate per 100, I'm going to take this percentage, I'm going to put it into decimal format, which is 0.0375, and I'm going to multiply that by $100. So that means this is going to become 3.75. And what this helps us to know is that for every $100 value of assessment, I could take that and multiply it by 3.75 to determine my taxable amount. Typically, most places don't necessarily use this number, but the book talks about it, so I wanted to include it in this presentation. So the next question says, what is the tax rate per thousand? I can do the exact same thing. I'm going to convert this percentage back to a decimal. I'm going to multiply it by 1,000 instead, and that's going to give me 37.50. And so, same thing, if I wanted to figure out how much taxes I owe, I take this number, divide it by 1,000, and I can multiply it by this dollar amount. Now, what you'll notice is that most counties are going to actually use the term mill. Mill is actually the same thing as taking it per thousand, but you don't put a dollar sign on it instead. So these are kind of like, this is a percentage times $100 times $1,000. Well, in this case, it's the same thing. I take 0.0375 times 1,000, and it's going to give me 37.50 mil. I'm not going to say dollars, I'm going to say mil. And that's just how we see the tax rate listed on different places. So this is also in the book, but when Hamilton County talks about their taxes on previous slides, I said it was such and such mil. That's what this is referring to. So the fifth question says, what is the base property taxes before adjustments? Well, I'm going to put this in, use the mil because that's kind of what we see in real life. So I'm going to say, all right, I have $52,500. I'm going to divide this by 1,000, and that's going to give me 52.5. I can then multiply this times 37.50, and that's going to give me 1968.75. So this is my base amount of my property taxes that I'm going to have to pay. That's the base amount with no adjustments. However, Matthew does have some adjustments that he needs to make. So I'm going to go on ahead and write that number up here again. It was 1968.75. And we're going to either increase or decrease his property taxes based off of these adjustments. So the first one says he has a reduction factor credit of $400. Since it's a credit, that means it's going to reduce his taxes by $400. This is a personal residence, so he gets a non-business credit of $100. So we'll reduce that property taxes by $100. It's owner occupied, so he gets a credit of $50. That's going to reduce the value of his taxes. He has a sales tax credit of $100 because he lives in that county and he pays sales taxes. Now, the current value of his home was updated, and with that new assessment, he now owes an extra $75. So in order to calculate out what his annual taxes are going to be, I'm going to take this original basis with no adjustments, subtract 400, subtract 100, subtract 50, subtract 100, and add 75. And when I do that, that's going to give me an annual amount of $1,393.75. So that is for the year. Now, part 2 says that Matthew pays his taxes every 6 months. What will his semi-annual payment be? So this is the annual amount. This is his annual amount. To determine what his semi-annual amount would be, I would take this, I'm going to divide it by 2, and that's going to give me 696.88. That is how much he would pay every 6 months.